In this video, we explain how mortgage insurance works. That's coming right up.
Welcome to Home Buyers School, brought to you by Brookfield Residential.
Hi everyone, welcome to another Home Buyer School video, a channel where you get the latest strategies, tactics, and tips from home buying experts. And remember, if this is your first time on this channel and you want to get the latest strategies from the experts, hit the subscription button below, hit the little notification bell so you don't miss anything. Today I'm joined by Mushtaba Sayed, Manager Mobile Mortgage Specialist with TD Canada Trust. And the question we're going to answer today is, what is a mortgage insurance? So Mo, I've heard 20% down, you have to get mortgage insurance below that. What exactly is it?
Yeah, absolutely. There's very different types of insurances that you can get, and a lot of different ones are actually tied into the whole mortgage process. So we'll start off with the first one, which is called mortgage default insurance. So a mortgage default insurance is actually required in Canada if you're putting less than a certain percentage of down payment down. So if you're putting less than 20% down, the banks will require you to get something called default insurance, which is actually offered by three different companies. So CMHC, which is Canadian Mortgage Housing Corporation, GE, which is stand as Genworth, and Canada Guarantee. Three separate companies that offer default insurance to the banks. So what default insurance technically is pretty much before default insurance were available, you would need a minimum of 20% down to buy a home. So these companies have come up and they've actually made it more affordable and easier for us to qualify for a home. We're putting less than 20% down. So now you can actually buy a home in Canada with as low as minimum of 5% down. So what that does in this scenario is that you get approved by your bank, and then the insurance company also approves you. And what they do and we'll take a look at to see is that we feel comfortable with this lender and we will provide insurance just in case that this individual cannot pay the mortgage, or as we call it, default. If they default on that mortgage, then that company is now insuring the banks. So that is the benefit of having insurance on it. What it does, it protects the banks, but also helps you get into a home sooner so you don't have to pay for 20%. There's definitely going to be a cost for insurance, like there's a cost for anything else. It's called insurance premiums, and they differ. They're very different with the percentage that you put down. If you're putting 5% down, your insurance premium is going to be different than if you're putting 10% down or 15% down or even 19% down sometimes. So you want to take a look, you want to see what the premiums are, what makes sense for you, and see how much you can afford, and then have that discussion there. Another insurance that could be tied into a mortgage process could be called life, critical illness, or disability insurance, which is more tied to yourself now. So default insurance mostly protects the bank, but these insurances actually what we call payment protection protects you as an individual. As we know, life is very unexpected. Anything can happen, God forbid. Let's say you or a loved one passes away, or they get sick, or something's happened at work and you're disabled, or some kind of disability is now affecting you from making your payments. These insurances are actually put in place so your actually payments can be paid on time. So you don't have to worry about losing your home. In certain scenarios, if you have life insurance or critical illness built into your mortgage and God forbid something's happened to you, most lenders will even pay off the mortgage as a whole completely and not just payments. So that's a benefit to you now, is because now you currently have your home, whatever it's worth, paid off completely debt-free, and now it's become an asset to yourself. So that's another great conversation to have, another great product to kind of look at in getting into a home. I feel a lot of clients don't get into mortgage life insurance, or they feel like it's not beneficial for them, and they maybe want to go and shop around for different insurances, which is definitely your right. You can definitely do that. The only thing when it comes down to insurance is you want to take a look at, you want to always be comparing apples to apples. Every insurance policy is not going to be very similar to everything else. There's so many different things built into a policy. You have to see what makes sense for you. Also, the other thing I recommend to people when it comes down to insurance is it's very easy to get insurance. The hardest thing for insurance is to get a payout out of insurance. You can pay into insurance policy for a very long time, and then God forbid something's happened. Let's say if something's built in the policy that you didn't read or write, and now you need that insurance to be there, they might be denied just for that reason alone. So definitely take a look, do your shopping around, but when you are comparing insurance policies, compare apples to apples. The last thing that I would consider to be insurance that's kind of tied into a home or a home purchase is what we call fire insurance, which is also mandatory by law to have. This is almost very similar to having like vehicle insurance. When you purchase a vehicle, you need to have a vehicle insurance for accidents, fire, theft, etc., etc. So fire insurance is also required to have, which it has nothing to do with your mortgage or with your lender is something that you do on a personal level. And you kind of do that for fire, if there's a fire in your home, or if there's a theft or a break-in your home, you would have those insurance put in place to kind of safeguard you and kind of protect you. So those are the 3 insurances that I would say are kind of tied into mortgages, home purchases, or real estate per se.
So for default insurance, how long do you have to pay that for? Is it for the length of the mortgage?
So a default insurance is a one-time fee. So it doesn't come out it's not a monthly thing. The insurance company will charge you one time and it will go on top of your mortgage. But once you paid it, it's your choice now. You could keep it on there, you can pay as long as you want to, but technically an insurance will always be there till you have enough equity in your home to make your mortgage from an insured mortgage into a conventional mortgage. A conventional mortgage just means now that the maximum financing on your home is no greater than 80% of what it's worth, or what we call loan to value, LTV. So you might have started off with 5% down, which means you have 95% lending on your home, and over time you paid that down to 80%. Now your home is actually gone from an insured to a conventional mortgage. So once again, it's a one-time fee. You can pay as long as you want to till you have enough equity to make your home conventional, and that's when the insurance will no longer be tied to your home.
Now, is it harder to qualify for a mortgage insurance, a default mortgage insurance, let's say for your second home?
So it really just depends. Some lenders, for example, not lenders, some insurance companies like CMHC will not lend to you again or provide insurance to you again if you already have one product with them. But there are other insurance companies available. There's Genworth and Canada Guarantee, which might. So one of the insurance companies wouldn't, but we do have access to the other 2, which can as well. So that's not the end all be all. So if you already have one home and it's insured and you want to purchase another primary residence, so technically that's the catch. Insurance is only for primary residence. You cannot purchase an investment property or a rental property and then you try to use insurance to qualify for that. It's just an added benefit for people looking for primary residences. So if you have one already, you can still qualify and get insurance. It'll just have to be with a different insurance company, and your lender will know exactly who to talk to and who to reach out to make sure that that property is insured for you.
So how long do you need mortgage insurance for? Like, I know I asked the question about length of the mortgage, but is it sort of like, do most people get another mortgage insurance when they buy their second home?
Yeah, so like insurance is tied per property, right? So technically the first property you get insurance is now that insurance is already tied to that property. It's not going to be able to carry over unless you're porting your mortgage to the new property. So if you're keeping your mortgage on the first property and now you want to buy a second home, there's going to be a whole new insurance on that property, because insurance is, like I said, tied to the property, not to you as an individual. And you can pay that as long as you want to, till there is enough equity in your home to make a conventional.
Perfect. Well, do you have anything else to add?
No, I think that's great.
Awesome. Well, thank you very much for joining us, and we'll catch you next time.
That's another edition of Homebuyer School. Tune in next time for more expert tips and tricks. And visit homebuyersschool.ca to bring you one step closer to finding your dream home. As with everything, it would be great if you like and share our videos. Also, please let us know if you have any home buying questions you want us to answer.